Trade tension between the United States and China have reached alarming levels, and these conflicts are proving to be more than just a matter of tariffs. As these two global giants continue to clash, the ripple effects are felt across the American economy, not just in ways we traditionally expect. The complexities of this economic situation have revealed vulnerabilities in several sectors and among individual states, potentially causing lasting damage to the broader economy. In this video, we'll explore how the ongoing trade war could impact various industries, what it means for jobs, and how it affects the state economies across the country. Agriculture and manufacturing. One of the sectors hit the hardest by the escalating trade war is agriculture. The U.S. agriculture industry is particularly vulnerable to Chinese trade policies, with nearly 180,000 jobs potentially at risk in industries like oilseed and grains alone. These losses are substantial. Many U.S. farms rely heavily on exports to China, so any disruption in this trade has severe consequences. The manufacturing sector is also under immense pressure. The potential loss of another 100,000 jobs in industries such as cutting-edge machinery, semiconductors, and energy production highlights just how interconnected global supply chains are. With China being a major purchaser of the U.S. goods, and the inability to quickly replace Chinese demand could cause significant upheaval. This is particularly concerning in the high-tech sector, where U.S. companies rely on Chinese both as a customer and a crucial supplier. The fallout from the trade war is not just about lost revenue, but also about the instability it brings to the critical industries that the U.S. relies on for technology, advancement, and engineering independence. Another sector that might not immediately come to mind is education. The United States has long been a hub for international students, with China being one of the largest sources of foreign students in America's universities. The potential withdrawal of Chinese students could lead to a staggering 120,000 job losses in the education sector. International students contribute significantly to the U.S. economy, not just through tuition fees, but through spending on housing, transportation, and other living expenses. This financial influx has helped many U.S. universities stay afloat, and has decreased enrollments could put the jobs of professors, administrators, and support staff at risk. The impact of these trade tensions isn't uniform across the U.S. The states most heavily reliant on exports to China are especially vulnerable in this conflict. States like Texas, California, Louisiana, Indiana, and Illinois are the forefront of these challenges. These states have built their economies around strong trade ties with China, and any disruption to those relationships could lead to severe economic consequences. For example, Texas is a major exporter of energy and technology to China, while California depends heavily on trade for its agricultural and manufacturing sectors. Similarly, Louisiana, which has strong ties for energy exports, and Illinois with the manufacturing industry are also at risk. These states could experience job losses, slow economic growth, and weaken industries, making them particularly vulnerable in a prolonged trade war. On the other hand, states like New York, which has a strong financial services sector, may be more insulated from the immediate effects of tariffs and trade barriers. However, the ripple effect from other sectors could still have impact, showing more interconnected all industries and states are together's global economy. The broader U.S. economy faces additional risks beyond direct job losses. One major area of concerns is the U.S. debt market. With Congress continuing to increase federal spending, there are growing worries among major banks how low U.S. bond yields, especially in relation to the rising inflation risk. A trade war with China could accelerate these pressures, pushing inflation higher and potentially causing a 10-year Treasury yield to rise from 5% to even 6%. This could make borrowing more expensive for both the government, consumers, and further slowing down the economy, growth, and increasing the cost of living. China's strategic position: China holds nearly $1 trillion worth of US bonds, giving the country significant leverage over the US financial markets. Should Beijing decide to divest these holdings or collaborate with other nations to reduce the reliance on US debt, it could have a devastating impact on the US borrowing costs and the value of the dollar. This situation could lead to global reassessment of the US debt. As international investors become more cautious about holding US bonds, especially in the light of potential reductions in trade with the US. The long-term consequences. While the immediate effects of the trade war are concerning, the long-term consequences are even more alarming. China is poised to overtake the US as the world's largest consumer market. The inability to replace Chinese demand with new markets quickly they could lead to a significant long-term risk for the US economy as China's middle class continues to grow. The US could find itself struggling to maintain its export markets and rely on less stable economies for growth. The ongoing trade war between the US and China is far from just a headline about tariffs. The implications of these tensions extend deep into the US economy, touching everything from jobs in critical sectors to global debt markets. With vulnerability stretching across states, industries, and economic systems, the consequences of prolonged trade tensions could reshape the US economy for the years to come. As the situation continues to unfold, it's crucial to keep a close eye on these tensions evolve and the potential impact for both nations and state economies. Stay informed and let us know in the comments below how you think the trade war will affect the future of the United States economy. Thanks for